Jake buys a rental property. Marcus puts the same money into index funds. They both think they made the smarter choice. They're both wrong because one of them forgot to count the hours and the other forgot to count the zeros. And when you actually run the numbers over 20 years, the gap will make your stomach drop. 99% of people get this investment decision wrong. If you want to be in the 1%, smash that like button. Subscribe now, because the next 15 minutes could change how you build wealth for the next 15 years. And share this with one friend who's obsessed with real estate or stocks. Let's see if they still agree after watching this. Let's keep this fair. Jake and Marcus both have $50,000 saved. They both earn $55,000 a year. They're the same age, same city, same financial starting point. The only difference is what they do with that $50,000. Jake uses it as a 20% down payment on a $250,000 rental property, a modest 3-bedroom house in a decent neighborhood. He takes out a 30-year mortgage at 7% interest. His monthly mortgage payment is about $1,330. He finds a tenant willing to pay $1,800 a month in rent. On paper, that's $470 a month in profit before he spends a single dollar on anything else. Jake feels like a genius. Marcus takes the same $50,000 and drops it into a total stock market index fund. No leverage, no tenants, no keys to hand over. He sets up an automatic contribution of $300 a month and doesn't think about it again. His co-workers ask him what he's investing in. He says, index funds. They nod politely and change the subject. Nobody's impressed. On day 1, Jake has a house, a tenant, and a story to tell at dinner parties. Marcus has a brokerage account and a confirmation email. It's not even close in terms of how it feels. But feelings and math are two very different things. For the first few years, Jake is living the landlord dream. Rent checks hit his account every month. He drives past his property and thinks, I own that. He's claiming mortgage interest and depreciation on his taxes, shaving a couple $1,000s off his tax bill each year. He's building equity with every mortgage payment and watching comparable homes in the neighborhood rise in value. Everything about this investment feels real, tangible, and smart. Marcus logs into his brokerage account once a quarter, sees the number go up a little, then down a little, then up a little more. His $50,000 grows steadily, but it doesn't feel like anything is happening. There's no key in his pocket, no tenant texting him, no asset he can point to from his car window, just a number on a screen. Jake's friends ask him about the property. Marcus's friends don't ask him about anything. The social proof alone makes Jake feel like he's winning by a mile. Then the real numbers start showing up. Jake collects roughly $64,800 in rent over the first 3 years. His mortgage payments total about $47,880, leaving $16,920 in gross cash flow. Sounds great until property taxes, insurance, repairs, vacancy, cleaning costs, and maintenance show up. After replacing a water heater, fixing a roof leak, and dealing with tenant turnover, his actual net cash flow is closer to $2,000 to $4,000. Not the $16,920 that looked so good on paper, and that doesn't include a single hour of his time. Meanwhile, Marcus has invested $50,000 plus $10,800 in monthly contributions. At roughly a 10% annual return, his portfolio sits around $76,000. He spent 0 hours managing it, 0 emergencies, 0 phone calls. Jake still has leverage working for him, though. His property has appreciated and is now worth roughly $270,000 to $280,000. His equity has grown to around $55,000 to $65,000. That's real wealth created partly with the bank's money. That's the advantage of leverage. But rent checks don't tell the whole story. Vacancy, maintenance, repairs, property taxes, insurance, capital expenditures, management costs, and bad tenants all take a bite. A rental property can sit empty, need a major repair, or face an eviction that wipes out months of profits. None of that shows up in the monthly cash flow number people brag about. By year 5, Jake has already dealt with multiple tenants, a roof replacement, plumbing emergencies, rising taxes, and increasing insurance costs. His actual cash-on-cash return after all expenses hovers around 3 to 5%, not the 15 to 20% return he tells people about. Marcus, meanwhile, keeps doing absolutely nothing. His portfolio keeps compounding. By year 7, it's grown to roughly $135,000 to $150,000. The gains on his gains are now generating more wealth than his original contributions. That's the power of compounding. It's boring for the first 5 years and astonishing for the next 15. By year 10, Jake's property is worth around $335,000 to $350,000. His mortgage balance has fallen, leaving him with approximately $170,000 to $184,000 in equity. Marcus's portfolio is sitting around $165,000 to $180,000. They're surprisingly close. Jake may even be slightly ahead thanks to leverage. But Jake spent hundreds of hours managing a property, took on significant debt, and concentrated his investment in one asset located in one neighborhood. Marcus diversified across thousands of companies and barely thought about his investments at all. By year 20, Jake's property is worth roughly $450,000 to $500,000. His mortgage is nearly gone or fully paid off. His equity sits somewhere between $400,000 and $500,000. After decades of maintenance, taxes, insurance, vacancies, and renovations, his total profit from cash flow might be another $40,000 to $80,000. Marcus's portfolio, assuming a 10% average annual return and $300 monthly contributions, has grown to approximately $420,000 to $460,000. He contributed a total of $122,000 over 20 years. The rest is pure compounding. No debt, no tenants, no midnight repair calls. When you compare net worth, they're in the same ballpark, somewhere between $400,000 and $500,000. But how they got there is completely different. Jake worked for his. Marcus waited for his. Jake dealt with stress, concentration risk, and illiquidity. Marcus dealt with volatility, but enjoyed liquidity and freedom. And here's where things get interesting. If Marcus simply increased his monthly contribution from $300 to $500, his portfolio jumps to roughly $550,000 to $600,000 after 20 years. That's because additional contributions get multiplied by compounding. In real estate, increasing your investment often means buying another property, taking on another mortgage,